Right now, while most people are scrolling past headlines and assuming this is just another distant geopolitical drama, something far bigger is unfolding beneath the surface. Something that could quietly reshape global wealth, energy markets, and the value of money itself. Because what just happened in Venezuela isn't only about a raid or a regime change. It's about who controls resources, who sets prices, and who ultimately wins when trillions of dollars silently change hands. To understand why many analysts are calling this the opening move of the largest wealth transfer in modern history, we have to slow down, strip away the noise, and look carefully at what Venezuela actually represents, how the global financial system is wired, and why a single U.S. action can send shockwaves through oil markets, currencies, precious metals, and even your everyday cost of living. Venezuela is not just another oil-producing country. On paper, it holds the largest proven oil reserves on Earth, larger than Saudi Arabia, larger than Canada, larger than Russia. We are talking about over 300 billion barrels of proven reserves, much of it heavy crude, locked beneath the Orinoco Belt. For decades, those reserves were effectively frozen out of the global system by sanctions, mismanagement, and political isolation. Think of it like a massive vault, full of energy wealth that the world knew existed but could not legally or efficiently access. While oil flowed from the Middle East, Russia, and U.S. shale basins, Venezuela sat there as the sleeping giant, its production collapsing from over 3 million barrels per day in the late 1990s to well under a million at its lowest point. That collapse wasn't just a Venezuelan tragedy, it was a structural shift in global energy supply that pushed prices higher elsewhere and made other producers extremely rich. Now fast forward to the present moment. The U.S. operation in Venezuela did more than remove a political leadership. It effectively reset the chessboard for control over one of the largest energy assets on the planet. When assets are frozen, when oil production is redirected, when sanctions are selectively lifted or enforced, wealth doesn't disappear, it moves. And that movement is what economists mean by wealth transfer. If Venezuelan oil re-enters global markets under new oversight, at scale, the beneficiaries won't just be Venezuelan citizens hoping for stability, but multinational energy firms, commodity traders, shipping insurers, refineries, and governments that gain access to discounted supply. At the same time, someone else loses pricing power, someone else loses leverage, someone else sees their revenues shrink. Oil is priced globally in dollars, and that detail matters more than most people realize. The petrodollar system means that every barrel sold reinforces demand for U.S. dollars, U.S. debt, and U.S. financial infrastructure. When control over oil supply shifts, so does influence over that system. If Venezuelan output increases by even 1 or 2 million barrels per day, that additional supply can suppress global prices, especially during periods of slowing demand. Lower prices sound good for consumers at the gas pump, but they can devastate high-cost producers, strain oil-dependent economies, and force central banks to respond. Countries like Russia, Iran, and even Saudi Arabia balance national budgets on oil revenues. A sudden surge of controlled Venezuelan oil into the market isn't charity, it's competition. And competition in energy has always been a geopolitical weapon. But oil is only the first layer. Beneath Venezuela's soil is not just crude, but gold, rare earth elements, and strategic minerals that matter in a world transitioning toward electrification and digital. Infrastructure. Venezuela sits on one of the largest gold reserves in Latin America, much of it previously mined illegally or smuggled through informal networks. When control tightens and assets are frozen or reclassified, ownership changes without a single coin physically moving. A gold bar sitting in a vault can represent wealth for one regime on Monday and a completely different set of beneficiaries on Tuesday, depending on recognition, enforcement, and access to international markets. This is where precious metals enter the story in a way that's easy to understand. Gold has always been money when trust breaks down. Silver has always been the industrial workhorse metal that quietly underpins modern life. When geopolitical shocks hit, investors instinctively ask a simple question: where is safety? If energy markets are being reshaped by force rather than negotiation, confidence and stability weakens. That tends to push capital toward hard assets, especially gold. We've seen this pattern repeatedly throughout history, from the oil shocks of the 1970s to the wars of the early 2000s. A disruption in one asset class causes capital to flee into another, and those who are positioned early benefit the most. Think of global wealth like water in connected containers. When pressure is applied in one place, the water flows elsewhere. The U.S. action in Venezuela applied pressure to energy markets, sovereign assets, and regional politics all at once. Capital responds automatically. DGE funds rebalance. Central banks reassess reserves. Commodity traders reposition. This is not emotional, it's mechanical. Algorithms don't care about speeches or morality, they care about risk and return. If Venezuelan oil becomes more accessible under U.S. influence, U.S.-aligned markets gain a strategic advantage, while others must adapt or lose ground. There is also a historical pattern worth remembering. Major wealth transfers rarely look dramatic at first. They don't come with a single announcement saying trillions have changed hands. Instead, they unfold over years through asset repricing. When the British Empire lost control of global trade routes, wealth didn't vanish overnight, it migrated. When the U.S. emerged from World War II controlling energy, manufacturing, and finance, the wealth transfer was cemented through institutions like the IMF and World Bank. Venezuela fits into that long arc. Control over resources has always been the foundation of global power, and whoever controls supply chains controls pricing, financing, and ultimately living standards. Ask yourself a simple question. If one country suddenly gains indirect influence over the largest oil reserves on Earth, while others face sanctions, debt crises, or declining production, where does wealth naturally flow? It flows toward those with access, stability, and enforcement power. That doesn't mean every American gets richer overnight. Wealth transfers are uneven, they concentrate, they reward insiders, institutions, and early movers first. Ordinary people feel them later, often as inflation, job shifts, or changes in asset prices. This is why analysts are watching not just oil charts, but bond yields, currency swaps, and gold flows. If Venezuelan oil sales are settled in dollars and managed through Western financial systems, demand for dollar liquidity increases. That supports us borrowing capacity while pressuring countries trying to de-dollarize. At the same time, nations wary of this concentration of power may accelerate their own gold accumulation as a hedge. That tension between paper assets and physical assets is the heartbeat of every major financial transition. Nothing about this is accidental. Energy security, currency dominance, and resource access are intertwined. The raid in Venezuela is one visible action in a much larger system that moves quietly, relentlessly, and with enormous consequences. The biggest wealth transfers don't announce themselves as transfers. They show up later as changed price charts, altered trade flows, and new winners and losers that seem obvious only in hindsight. And this is only the first layer of the story, because to truly understand why this moment could dwarf previous wealth shifts, we have to follow what happens next. How markets react, how precious metals signal stress, and how ordinary people end up paying the price or finding protection because the real shift doesn't happen at the moment of force or headlines. It happens in the quiet aftermath, when markets begin to reprice reality, when contracts are rewritten, and when money starts flowing in directions most people never see until it's too late. After a shock like the U.S. action in Venezuela, the first question global investors ask is not who won politically, but who now controls the cash flow. Oil is not just a commodity, it is a revenue stream that feeds governments, banks, pension funds, and entire national budgets. When that stream is redirected even slightly, the cumulative effect over years can reach trillions. Let's break this down in simple terms. Imagine Venezuela's oil sector as a factory that has been running at 20% capacity for years because the doors were locked and the machines were falling apart. Now imagine those doors opening under new management, with foreign capital, technology, and logistics ready to step in. Even conservative projections suggest Venezuelan production could rise by 1 to 2 million barrels per day over time if infrastructure is stabilized and sanctions barriers are selectively eased. At current prices, that represents tens of billions of dollars per year in additional oil revenue flowing into global markets. But the key question is who captures that value? It is rarely the population first. It is usually the entities that finance, insure, trade, and refine the oil. This is where wealth transfer becomes measurable. Energy trading houses lock in long-term supply contracts at favorable terms. Refineries secure discounted heavy crude feedstock, boosting margins. Shipping companies see increased volumes. Financial institutions that clear dollar-based transactions earn fees and strengthen balance sheets. Meanwhile, competing producers face downward price pressure. Shale producers with higher break-even costs feel the squeeze. Oil-dependent nations with fragile budgets must either cut spending, borrow more, or devalue currencies. Wealth doesn't vanish in that process. It shifts from one balance sheet to another. Historically, this pattern is consistent. When Iraqi oil returned to markets after conflict, global prices adjusted and capital flowed toward those controlling logistics and financing. When Libyan output collapsed, others benefited from higher prices. Venezuela is unique because of scale. The reserves are so vast that even partial normalization changes long-term supply expectations. Markets price the future, not just the present. If traders believe Venezuelan oil will be steadily available under U.S.-aligned oversight, that expectation alone suppresses long-term price projections, affecting futures curves, investment decisions, and exploration budgets worldwide. Now layer in currency dynamics. Oil priced in dollars reinforces dollar demand. Every barrel sold requires dollar settlement, dollar clearing, and often U.S. financial intermediaries. That strengthens the dollar's role at a time when many countries have openly discussed alternatives. If Venezuela's oil flows are reintegrated through Western systems, it quietly counters de-dollarization efforts elsewhere. This is not ideological, it is structural. Central banks hold reserves where trade is settled. If energy trade reinforces dollar usage, central banks follow. That creates a feedback loop where U.S. financial assets remain attractive even as debt levels rise. At the same time, countries watching this unfold draw their own conclusions. If access to resources can be reshaped by force and financial controls, then holding too much wealth in paper claims becomes risky. This is why gold matters here. Gold is not controlled by contracts or clearinghouses. It has no counterparty risk. When geopolitical power asserts itself over energy, gold often responds as a hedge against political risk. We've seen central banks quietly accumulate gold during periods of sanctions, conflict, and currency weaponization. Venezuela itself experienced this when gold reserves became a lifeline under sanctions. Now the same logic applies globally. Silver plays a quieter but equally important role. Unlike gold, silver is both money and an industrial metal. It is essential for electronics, solar panels, medical devices, and defense systems. Any reshaping of energy supply chains affects industrial demand forecasts. If oil prices are pressured lower, governments often accelerate infrastructure and energy transition spending to stabilize growth. That boosts silver demand. So while headlines fuck us on oil, the ripple effects touch metals markets in subtle ways that only show up months or years later in price charts. Another overlooked aspect is debt. Venezuela has defaulted on tens of billions of dollars in sovereign debt. Control over future oil revenues determines who eventually gets paid. Bondholders, hedge funds specializing in distressed debt, and restructuring experts all stand to gain if production ramps up under enforceable governance. That is another layer of wealth transfer, from a failed sovereign balance sheet to investors willing to wait. Debt restructuring is not charity, it is opportunity for those with patience and legal leverage. Think about this from a household perspective. When interest rates move, when fuel prices change, when currencies fluctuate, everyday costs adjust. A shift in global oil supply affects transportation, food prices, manufacturing, and inflation expectations. Central banks respond to those signals. If oil prices fall due to increased supply, inflation may ease temporarily, giving central banks room to pause or cut rates. That boosts asset prices, especially stocks and real estate, benefiting those who already own assets. Again, wealth concentrates. Those without assets feel relief at the pump, but may miss the larger gains elsewhere. This is why calling this a potential historic wealth transfer is not exaggeration. It is not a single transfer, but a chain reaction. Energy affects currencies. Currencies affect debt. Debt affects asset prices. Asset prices affect inequality. And all of it traces back to control over resources. Venezuela is a catalyst, not the entire story, but its scale makes it powerful. There is also the psychological dimension. Markets run on confidence. When a dominant power demonstrates willingness to act decisively to secure resources, it changes risk perception. Some investors feel safer under a system with a clear enforcer. Others feel threatened and seek hedges. Both reactions move capital. Safety-seeking money flows into U.S. assets. Skeptical money flows into gold, silver, and alternative stores of value. Either way, money moves. Ask yourself this: if you were managing billions and saw energy supply being consolidated under one sphere of influence, would you sit still? Or would you reposition quietly ahead of the crowd? That repositioning is already happening, even if it hasn't reached mainstream awareness yet. And this brings us to the next critical layer, the one that determines whether this remains a regional reshuffle or becomes a truly global turning point. The response of other major powers, the acceleration of precious metals accumulation, and the subtle signals markets are already sending if you know where to look now.